Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So thanks everybody for joining. This is our multifamily investing online meetup, 0 to 1. Here we focus on getting you from zero multifamily investment to your first multifamily investment, either as passive investor or as syndicator. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. So I am Marcelo Cazini. My background is in IT consulting and software development with an MBA from Texas A&M, and I'm a certified project manager by trade. I'm also a CCIM member. I completed all of the required CCIM designation trainings. And right now I'm also a multifamily investor, and I own and operate commercial real estate. And I've also done single family real estate before getting to multifamily a couple of years ago. And I will get to Claudia and Martin to introduce themselves.
Okay, thank you. We're also based out of Houston, Claudia and Martin Rubio. Today I'm broadcasting from one of the largest airports in the world. So I'm in George Bush Intercontinental Airport. So pardon the noise and all the interference here. Claudia and I have been working on real estate for several years in the multifamily space for the last year and a half. We started researching how to do passive investments, and we are now syndicating our first deal here in Houston. As of now, we have almost 600 units as general partners or limited partners. And Claudia holds a National Apartment Association IRAP certification related to multifamily. Our background is mine on consulting, Claudia on asset management. I don't know, Claudia, do you want to add something?
I'm also an architect. I got the degree back in Colombia, but I've always worked managing my own properties, all type of assets back in Colombia and now here in the US in multifamily.
All right, excellent. Thanks, Claudia and Martin. So with that, today we're excited to have Louis Huston as our guest. So Louis, do you want to go ahead and introduce yourself?
Sure. Thanks for having me to you guys. I appreciate you guys bringing me in to speak and answer questions to help people go from 0 to 1. I mean, that's literally what our intent is. So I'm originally from New York City, but I've been a Texan transplant for a very long time. I'm an accredited real estate investor. I'm in currently 18 deals, about 4,500 units. So it's just a little bit off from what's here, but that's okay. I'm a school nerd. I love learning. And if there's one thing I can say that's going to be important for you guys is to continue to want to learn. Even to this day, I still love to learn. So I've gotten an executive MBA from Northwestern, and I'm currently part-time, I would say. I own my own executive coaching consulting firm. So that's what I do, but I love real estate. It gave me an opportunity to exit the corporate world, and now I just work when I want to work. So, because I need to keep the brain going. So, but I'm a nerd at heart. As some of the questions will come, you'll learn I have an IT background as well. But I've lived all over the world doing IT and love it, but I made sure to have an exit strategy. So that's my story, and I'm ready to answer any question any of you guys have about my experience and share my knowledge.
All right, excellent. Martin, do you want to get started with a few of the questions?
Sure. That's awesome, Louis. We're very excited to have you on the meetup. we know you have a lot of experience from the passive side, and you're also syndicating. But I think your experience on all these years investing is very valuable for anyone trying to get into investing passively on that first deal that you usually are very eager to go into this space and invest, but you're also very careful on what type of deals you get into. So I think we're gonna try to pick your brain as much as we can. So as a small summary on how you got to multifamily, did you have any prior real estate either investing experience, or did you do any single family, anything like that, or did you find multifamily and went straight into it?
My story starts with multifamily. I never did single family at all. I am not good at people calling me in the middle of the night, or me trying to find other people to work with or to lease to. I didn't want to have that responsibility. One, because I was traveling so much, I couldn't do that and do it well. So one of the key things I did was I started to research, how can I make passive income without, being there, and multifamily was it. So I literally went around to all these different places to learn about multifamily. And as a result, I learned there's a lot of shady people out there teaching training. And I was like, no, I would go to a lot of these events and say, nope, that's not for me, or yes, that is for me. Let me dig in, find out, and get some recommendations. So I literally went straight to multifamily. And that was key for me because of the amount of traveling I was doing at the time that I started in space. And if I can tell you, my first deal was a big one. My first deal was back in 2010. It was for a portfolio of apartment complexes. There were 4 or 5 apartment complexes in this first deal. And I remember talking to the lead, and I asked him a lot of questions because he was trying to sell me. And I was looking at him with my arms crossed, like, right, this is my hard-earned cash that I'm going to invest. I don't believe it. And we kept talking and talking. And then I literally looked at him and said, how much money you have in this deal? And he said, 650. And I said, how much you need? And I wrote a check. And the reason that I did is because I said, he's not going to lose, that amount of money. And until this day, we still own that property. I've already received all my original investment money, and we're getting 10 to 12% a year back from cash flow. And it's been doing that for 10 years now. So yeah, we've owned the property for 10 years. This year will be our 10th year. So what I'm going to get back in distributions is what I put in investing, what I put in my investments. So that's one of the success stories that I have, is my first one. So I was pretty blessed.
That's awesome. So when you started, did you mentioned education is you're big in education. Did you go for some third-party education to learn how to evaluate, how to invest? How did you go? How was your learning process before you did your first deal?
Yeah. So everybody talks about reading Rich Dad Poor Dad and reading all the books and all that stuff. So I had a lot of book education. And after the book education, as I said earlier, I went through and visited all these different apartment investing seminars that they advertise on the radio. And I went to the hotels and listened to all the deals, or people were trying to sell training systems. And I was like, mm-mm. Then I went in Houston, I went to Lifestyles Unlimited, and I was pretty impressed with their total portfolio, because not only did they talk about single family, they talked about multifamily, which is where I wanted to focus. And so after I went to a number of their sessions, because they offer some training, I went to a number of their sessions, and I actually, and at that time, there was no Sunrock or Rock, all these other players that are there today. It was Lifestyles Unlimited, and I joined their ecosystem. And from that ecosystem, I got to know who were the top leaders or the top syndicators. They can't tell you that information. They can't tell you who's good because that puts risk into the ecosystem. So literally what I did was I just walked around in their building and looked at who was getting all the awards. And then what I did was I wrote all of them letters and said, I have capital. Are you in a deal? And I got back responses. And then it was about learning how to analyze a deal. That is the key learning that I think anybody that's getting into this space really needs to understand is, how do you analyze a deal once you receive it? Just because your friend is getting into a deal isn't a good reason for you to get into a deal. And that's because your risk profile is going to be different than your friends. So what I did was I figured out my risk profile, and then I started to make calculated decisions. And I did one deal in 2010 and one deal in 2011. That's how I structured it in the beginning. Now I have friends joining, and I know people that are doing 3, 4, 5, 6, and 7 deals in a year. And I'm like, man, they drinking the Kool-Aid. You know, I'm like, they're really going. But I'm like, you know, I had to tell one of my friends, slow down. There's going to be plenty of deals. Just make sure you're picking the right ones, not just throwing your money into every deal because you have additional capital. So, but you got to be real smart and real particular. But learning and getting a mentor is key. Finding someone that's in the space that can help you. I had somebody like that helped me in my first deal. I was like, is this a good deal? And they were like, well, yes, here's good. Here's some questions that I would ask. So that's what I do with other people now. I want to help other people get to their first deal quickly. So like you guys, I think it's important to keep doing things like this because it's going to help people understand the language, and it's going to increase their network so that they can feel comfortable calling somebody like you or I and asking, hey, what do you think about this? Or how can I learn how to do a deal better? Or how can I invest in a deal?
Perfect. I think we have a couple questions. There's an iPhone question. I can't see the name. Do you want to
go?
If you raise your hand before Clayton, do you want to ask a question? All right, Clayton, why don't you ask your question?
Hey, Louis, thanks for being on tonight. Hey, so, you know, tonight's meetup is kind of focused on passive investing, and you mentioned something about, you know, self-education, learning how to analyze a deal and how that's important, and, you know, understand the you know, pro forma and the risk associated with your financial investment. But can you talk a little bit over your last, you know, 19 years of doing this, how you've learned to analyze the deal sponsors, and specifically, what are some red flags that you know, you consider red flags? I mean, it could be something like, you know, sponsor doesn't have any money in the deal or whatever, but what are some things that you picked up along the way about how to best analyze a deal sponsor?
Yeah, great question, Clayton, and thanks for it. Yeah, I have some red flags. I have a lot of people and sponsors that I know that I probably won't invest with because if I don't know them, first I got to get to know them and listen to how they talk about the space and make sure they're using the correct language, they know the terminology. I want to understand, are they willing to give me a reference, one of their current passive investors who I can talk to? Are they willing to give me a couple of names that are on their list so that I can go inquire with the other passive investor about how they communicate? And I've been in 18 deals. I would say out of all those deals, there's only one where I had to chase a syndicator to get monthly reports. And when I chased him, he was like, well, Louis, I don't know what I don't know what everybody wants. I said, I don't care what you send everybody else. I need you to send me monthly reports. Now, you should be sending monthly reports to everybody, but I need to know what's going on. Some red flags I have is like that. If a sponsor tries to ghost you, but that's after the fact, Clayton. So that's not answering your question particularly. Prior to investing my money, I want to know how much money they're putting in the deal, number one. If they're not investing into the deal, and I'm talking about their own money. And let me be very clear about what I mean by that. That's not money that they're getting from other investors and they're saying they're putting $400,000 into the deal. Because sometimes they're just getting 4 additional investors and saying that's their money they're putting in the deal, and they're double dipping and double counting. So I'm asking them, how much is coming out of your bank account and going into the deal, not how much money is coming out of the deal from an investment perspective. And so I know, because I know the games that some people play, so I look out for that. The other thing I do is I look at their performance. You know, I want to know, how have they done? I'm going to talk to their a few of their other passive investors to find out, do they communicate well? Do they communicate when there's problems? Are they transparent about the communications? Those are the kind of things that are going to be key for me. When I'm selecting an investor, a syndicator, I look at their entire body of work. I don't even mind if they don't do well on a deal. I've had one syndicator where I've done, 2, 3 deals where we've done over 200% in those deals. And then we have one that we're about to close on that's probably going to do 10 to 20%. And I'm like, I'm still not going to look at him like, oh, you're a failure because you did 10 to 20. I'm like, I understand the game or the model that sometimes, you're not going to always hit a home run. Sometimes you're going to hit a single. But I'm asking a lot of questions about their performance. I'm asking questions about what they do when there's a problem. And this is what I ask them before I invest with them. I'm asking them, have you ever had an issue where you had an investor that wanted to get out? What did you do? When you're not performing well, what did you do? And then I listen to their response. And then I talk to their passive investors to see, did they actually do that? Because they can tell me whatever they want. But I'm going to follow it up by talking to some of their passive investors, especially if you're new in the space. Even if somebody was getting ready to invest with me, I would want them to ask me lots of questions and then ask me, are you willing to share some of your passive investors to talk? And I would say, you talk to anybody, I would give them a list of people who they could talk to see, am I on the up and up? And I do that today, even with people that I'm trying to bring into the space. So, but I think those are kind of the important elements that I would probably share for people that are looking to investigate, or I would say before you put your money with somebody, make sure you have a good feel with them and trust your gut.
Good. Clayton, you had a follow-up question?
Yeah, so say you're a passive investor, you feel like you've done sufficient diligence on the sponsorship team, you don't really fundamentally have any problem with them as, people, or you don't think, when you're reading the subscription agreement and the PPM, what are some things that give you anxiety or cause you to have pause when it comes to, like, fees or GPLP compensation or equity split, those kind of things? What are some red flags with regard to that?
Okay, it's a delicate question. And I'm going to start it off with, it depends on who the sponsor or sponsors are. Do I worry about things? And let me give you an example. So acquisition fees for me, for the most part, is a no-no. If I see an acquisition fee, basically all people are doing is taking that money at closing and filling their pockets because they found the deal. And when I say acquisition fees, I'm talking about acquisition fees that are over $500,000, right? So if somebody's doing $100,000, I'm kind of like, okay, they're trying to recoup some of their, the money they put down. So I kind of can understand that. But people that are saying, well, I'm going to take $600,000 or $800,000 out of the deal, I'm like, you have to be very, very experienced. So for example, if Brad Sumrock or Grant Cardone are taking an acquisition fee, I'm probably not going to have a major problem with them taking a fee because they're very experienced and they know what they're doing, and my risk level should actually go down. But if Lewis Houston comes out, who's a he's a new guy and he don't know, this is his first deal. And he's talking about, I'm doing an acquisition fee and I'm going to take $250,000. I'm like, well, I don't know. You ain't gonna get my money. And there've been people who I've known very well who I won't invest with because of the acquisition fee. So acquisition fees are a concern, but I'm gonna tell you something. The thing that I pay attention to the most, that are my flags and the things that I do, I immediately go to the business plan and the market survey. When I look at a deal, the first thing I'm looking for is their business plan of what they're planning to do. And I actually look at the 1-bedroom prices. And why do I do that? A property manager who who I was speaking to, he told me, he goes, if you look at, 1-bedroom apartments and you look at the comps in the area, you can find out where your price point is. And you can actually look to see, is that business plan, do you believe it's doable? Because that's what you're assessing. That's literally what you're looking at. You're looking at that business plan and saying, they are predicting that they can raise rents by, 100, 200, 300, whatever amount of dollars they're planning to raise it. And here are the amenities that they're going to produce. I'm also looking at the timeline. How much per unit, if you got $5,000 in repairs, or $5,000 per unit in, upgrades you're planning to do, I'm like, that's going to take a serious project. So I need to prepare my brain. I might not get a distribution until 9 months or later. I'm doing all those calculations in my head while I'm reading the business plan. And keep in mind, every business plan looks good. They all make it look like it's beautiful and it's priceless. But I'm like, yeah, I don't believe it. And I hope they do it. They just won't do it with my money, because in my risk assessment, I'm not ready to give my money to that deal because I have some concerns that they're not going to be able to produce that in a timely fashion. So those are some of the things that I think about as I'm going through the business plan. Do I truly believe it? I look at the 1-bedrooms to see, are they below, if I look at the comps, are the 1-bedroom prices lower than the market, than the market average? And if it's higher or at the average, I'm like, are they really going to be able to raise rents to a higher level with the amenities they're planning to put in? And if they are, I might take a risk and put my money with it. And then I just watch the reports, and I look for when they're planning to do their first distribution. And then I look for people that do reports, because I ask for sample reports of the sponsors that I don't know. I ask them to send me sample reports of deals that they've done. And why do I do that? One, I can look at the language and how they send reports and what they communicate to their investors. And I get a sense for the amount of detail they're going to provide. And that gives me either a comfort or discomfort level, and then I move forward. So those are some of the things. It's not the total, but I'm sure, when we meet up at a next meetup, keep asking me, and I'm sure I'll keep telling you everything I do. I don't mind sharing all my stuff. I'll tell you everything.
Mm-hmm. I wanted to follow up on a really good point that Luis made, and it's that there's no such thing as a bad deal or a good deal, because when you start in this phase, you start looking for a good deal, right? But there's no such thing as a good deal or a bad deal. All deals are good for someone, right? So it depends on the level of risk that you're willing to take. And Louis' approach, very similar to us, is a very conservative approach in which I'm willing to take this amount of risk for this amount of reward. So it might be a good deal for someone else who has more experience and is willing to take that risk that I'm not willing to take, right?
Right. And to move more to something that Clayton was asking about, which was, do you look at the split level? Not really, because I think there's enough money in the total deal. Do I like sponsors that give a little more than the 80%? They're going to give the investors more money? Sure. But when it all shakes out, the league's going to make more money. So I'm not worried about them making more money. What I worry about is, how much money do they predict they're going to give me every quarter, or annually, as they say, cash on cash return, and then how much money they're planning to do on a total deal. That's what I'm making my decision on. I'm not really making it on the split. because everybody can make the split, work the split. Now, if somebody's, talking about, if somebody's saying, well, we're going to give the investors 88% and we're only going to take 12, I'm kind of like, I might give that deal a little better look, because there's going to be more money in the kitty for the investors versus somebody that's 20/80, where they're like, no, we're going to get ours as a leads. And I'm like, yeah, I get it. And I'm not afraid of those deals. I'm just going to look at it just with a slightly different tilt. But it's nothing that's material enough for me to go, I'm only looking at deals where they're doing, 15% or below. That I don't get into the splits because unless you're doing deals outside of an ecosystem where you got people that are doing deals that the leads are taking 30, 40%. I'm not doing those deals because I can go somewhere else to make money and get more of a better deal.
Yeah, absolutely. Chris Coronado, I know you raised your hand there and you had a question. Do you want to go ahead?
Yeah. Sorry, that was me earlier that raised my hand, but I had a little bit of technical difficulties with the phone there, and it canceled me out, so I had to get back in. But anyways, a lot of good points there, Louis. Was looking to ask kind of a follow-up question with regards to the returns, the projected returns that you were referencing there towards the end of your comments there. My question is, have you found have you nailed down a good way to go in and verify the projected returns that the general partners have promised versus what they're delivering, and somehow you really have to do that by quarter or maybe annually? And what's your method to kind of put all that into perspective and to kind of track that?
So I don't know if you guys are connected with a gentleman by the name of Lane Villegas. He has a tracking spreadsheet that he's made available to the entire ecosystem. It's a good one as a starter set, where when you decide to invest in a deal, you literally put in the pro forma data that the syndicators give you. And then when you get returns, you actually enter in the total return, and it keeps track of your total amount. And it tells you the actual percentage that you're actually getting. Now, I will tell you, one of my syndicators is really, really good, and he's a good model to follow. I've shared this with a number of first-time syndicators, and what they do is they show their reports with their pro forma numbers dotted, and then they show the actuals of what they're actually delivering, so that even if they're a little below, they can say they're below, but they can explain why they're below. And if they're above, they can talk about that. So I've really put that as a comment. And then I know Charles Lemaire, a friend of mine in the ecosystem that we are members in, he's trying to get some standardization. And so I know he's been pushing it. I don't think it'll happen, but we're all trying to make sure that we can highlight actual performance versus what you predicted. It's kind of like, any business that you said, I think I'm going to be able to make this amount of money. And then every quarter you're looking at the results. So it's really about tracking. You got to stay diligent as an individual about tracking your investments. I track mine. I look at the reports I receive, and I have to qualify that. Once I get all my money back, I'm not so interested in reading the reports as diligently as I did prior. The ones that I read diligently are the ones that are not performing well, and the ones where the ones that are performing at pro forma or above, I skim those. The ones that are doing, I have one that wasn't doing well, and I'm like locked in. What are you doing? And I'm chasing the syndicators to say, hey, how are you doing? And I'm not afraid to ask questions, because there's a lot of times when you're a passive investor, you don't want to bother the syndicator. Let me tell you something. You are an owner. As a passive investor, you need to be treated as an owner. Just because they're syndicators, they just have some additional responsibilities, but you are an owner, and you should feel free to ask questions. I ask lots of questions. I ask the Staples questions. I ask the Garzas questions. I have no shame in my game. Now, that's because I've been doing it a while and I'm very experienced, but that's just who I am. If I don't understand something or I don't understand what you're doing, I'm going to ask. You can ask Shane Thomas. One time I blitzed him he was doing another investment and I didn't think he stabilized the property and I thought he was moving too quick. And I had just did a deal. I invested in a deal that he put out. Forgive me for getting the months incorrectly, but let's say I invested with him in May. He came back with another deal in June saying, we got another deal. We're ready. And I was like, we just closed in May. How he's going to have another deal in June or July? I was like, I got on the phone. I was like, whoa, what's going on? And I was, blazing and asking all my questions. He's like, wait, Louis, wait. And when he explained it to me, he said, Louis, the apartment complex down the block, we can use the same staff, the same people. And when he put the story together, I was like, okay, you know what? And I'm an investor in that. And surprisingly, both, or not surprisingly, but both properties are doing great. They're at 98, 97% occupied. They're doing monthly distributions now. So do not be afraid to ask questions when you're an owner. If you don't understand something, ask the question. Terminology, if they put something in there you don't understand, ask. That is important to do as a person who's investing. But before you invest, ask for example reports that they send out to their investors. That's going to tell you a lot about that individual, and it'll help educate you as well.
Yeah, absolutely. And when we were looking for your first deal to get started, did you only look into one particular market, or were you just looking all over and focus more on the lead? How did you make that decision for their first deal?
I wanted to place in Houston. So I looked in Houston, and this is back in 2010. I looked in a place in Houston, and it was about the syndicator who I wanted somebody that was a big dog that was doing deals, had experience. And I found a guy that he was buying apartment complexes and portfolios like 2 and 3. And so, and that's how I approached it. I would tell people, even if you get with someone who's brand new, so all the people who are, who are thinking about being syndicators, what you have to be able to do is give confidence to a passive investor like myself or a new passive investor that you're going to do the best you can. It's not that you're going to make money. That's the ultimate goal, but you're going to do what you can to give them that comfort that you care about their success. So there was one couple that I invested with maybe 3 years ago. It was their first deal, but because they were partnered with an individual who I had invested with before, that's how they got my name, right? Because they partnered with a person that I had been invested with for about 4 or 5 years. And I literally went to my contact who was the syndicator that was partnering with them, and I said, tell me about them. And he was like, no, they're good. They're good. Well, so I submitted, I did the investment. 30 days after I did my investment, those 2 individuals called and asked to schedule a time for all the people who they didn't know. They wanted to have a quick 15, 30-minute meeting with them to understand about their investment goals. And in that 15, 30 minutes, the first thing I said to those individuals were, you just got some brownie points from me because you reached out to understand about me. I'll make sure I invest in your next deal. And I did. And they're doing well. They delivered after 3 months of ownership. They would get the distributions on both deals. Now they go into yield plays a lot, but they still deliver. And that was good for me and all the other investors. Other questions? I'm ready.
Louis, going back to your very first deal,
Yes.
How long did it take you since the moment you decided you were going to start investing passively until you wrote your first check?
A month.
A month.
A month.
Wow.
Now let me explain how that was, and that's a good question, Claudia, and it's a good question. I had already prepared my brain that I was going to get into real estate.
Mhm.
Then I had to say, it's time to stop talking and time to start doing. All I have to be able to do is prepare myself to say, do you know how to invest? So I spent a month talking to a lot of people, looking for a deal. Once I found deal, I was like, okay, I don't know how to analyze this so well. All right, let me figure out how to analyze. And I was in there analyzing. Now, keep in mind, I'm a nerd. So I was using all my resources that I possibly could, whether it was online, talking to friends, and talking to my mentor. And I was like, I knew I had to get into this. And my driver was, I worked for Shell Oil for 20 some odd years and was one of the lucky ones to be able to retire from Shell. But I was one of the persons that was, the reason I lived all over the world is because I was starting up countries. And then I was also one of those that was shutting down countries. And I knew I'm going to be one of those people that was saying, okay, we're going to have to lay off people. And so I said to myself, it's only a matter of time before they're going to be like, Lewis, it's your turn. It's time for you to go. And I needed an exit strategy. So I built one. And then I was able to leave on my terms instead of the company coming in and saying, hey, it's time for you to go. I was able to leave, but that was my driver. And so back in 2010, I was still living overseas. I was living in the Netherlands, and I came back and I was like, I need to invest. I gotta go. I can't wait. And that's when I jumped into my first deal. Now, the follow up to your next question is about how long is it till my next deal?
That was not my next question, but
I'll keep going. It was another year. It was another year. Now, what was I doing in that year? I was studying the reports that I was receiving from my investor. Any distributions I was getting, I was throwing into my account. I took, more education to learn how to analyze even more and do more. And so I took all the passive investor training that Lifestyles had at the time. I was going to events, and then I got tired of going to events because they were talking about, they talk about single family and multifamily. I wasn't interested in single family at all. I only wanted to talk to multifamily. And so I locked in on that stuff. And then that next year, I did another deal with the same sponsor. It was another portfolio deal. And then my third deal was the following year, where I called my sponsor and said, listen, I have some capital. Are you doing a deal? And he was like, no, but I know this other guy's doing a deal and he's pretty good, Lewis, and I think you should invest with him. And that's how I got my third deal. So my first three deals were two with the same syndicator, and then the third one was, and those properties were all in Houston.
Yeah, I was going to ask that a little bit more about your first deal, location, number of units, class.
Location, Houston. There was 4 apartment complexes. One was in Pasadena. The total portfolio size was about 700 doors. And it was, and I did a 6-figure investment. My first investment, I was like, if you're going to go. And if you're going to go. So it was, there was 2 apartments in the Gessner Beltway 8 area, 1 in Pasadena, and 1 in Channelview. So it was 4 apartment complexes, and we still own them today. They probably were at what, 8 to 10,000 a unit then, and now they're around 60 to 80.
Wow.
So wow. I'm like, hold it for a couple more years, and if it drops to 50, sell. But I'm just kind of like, just sell one of them, get out of it and let's go, So we're those were, those, to be in 3 deals from 2010, 11, and 12, those are good. But I've gone full cycle in a number of deals as well.
So what would be your best advice for somebody who's starting now to try to get into passive investing?
first understand your capital situation. I think that's very important, whether you're using 401 self-directed money, which is pre-tax dollars, or you have capital. Make sure you have capital. And even if you don't have capital, the capital situation says when you can go. What you should be doing up until you're ready to go is educating yourself about investing. That means learning what's a good deal, what's a bad deal, what's a risky deal. And so I want to change my terminology from good and bad to risky versus lower risk. And that, because that's going to be different for all of us that are on this call. Your risk level is going to be different than mine, and your experience level is going to be different. So I think that's the one thing I would tell you. There are plenty of books out there to show you how to analyze a deal. There's a book. I know you guys had something about asking me about resources or what books I read, and I read all the time. The Best Apartment Investment book. That book is a good book to read for a first timer. It's a book that I give to the people that I know are thinking about investing. And I actually read it. It's called The Best Ever Apartment Syndication Book. It's by Joe Fairless. I mean,
Joe Fairless, yeah.
You guys know who that is. I mean, so that's a book. Now, another thing that I do is there's another book that I love called The Miracle Morning Millionaire. That book is by Hal Elrod. Really good book about how do you set yourself up for success by putting in some practices in your own self about how you wake up in the morning, how do you get ready for the day, how you start to say, how do you build your dream and vision, and how you're going to actually say, I'm ready to go. Because that's going to tell you, about, how you set your process up versus just waking up and going, okay, I want to be a millionaire. No, there's definitely ways to do it. And it's not easy. Be ready to grind, be ready to work, because this space takes work and it's not easy, even as a passive investor. And let me tell you, I'm a passive junkie. And the reason why I'm a passive junkie, because I don't want to work. I want other people to work. Right. And so me, the reason I'm syndicating now is just for a personal reason of buying my own at one day. So I want to learn the steps that you need to do and all that kind of stuff. So, but passive for me is the way to go. And that's what I did. My first 14, 15 deals were all passive.
Perfect. Jason, you had a question. Do you want to unmute yourself and ask a question?
Yes, thank you. As a prospective passive income person, are there documents that should be, say for myself, I should be asking or need to look at, besides hearing the words from a syndicator and all the good verbal numbers there?
Yeah, good question, Jason. I mean, I think the one thing you will learn is that the syndicators are going to have to provide you some documentation. They have to provide you a PPM, personal memorandum. They have to provide you an operating agreement, and those are going to be some long documents. My advice to you as a first-time passive investor is read those documents and ask questions. They're lengthy to read, but they're important to read so that you understand how the model works. Any good syndicator is going to provide that documentation to you before you you have to sign that documentation to get into a deal. Or I should say, a good syndicator will have where you sign that documentation before you join the deal. But I also think it's about education, having a team. You should find, go to a meetup, talk to a couple of experienced people, and then take one of those experienced investors to go to Starbucks or coffee or lunch or something and talk to them and, be an information sponge, take all their data and learn from them. There's plenty of us who will share our knowledge. Don't be afraid to, don't think you're bothering us. I think a lot of first timers, they get intimidated. And I don't want you to be intimidated. I want you to jump in and ask questions and ask for help. Don't be afraid to ask for help. But I would
Thank
also
you.
say, if you can, join a third party, because if you join an ecosystem, they already have. The only reason I join the groups that I join is for access to deals and education.
Right on.
Yeah, and I would also add that as you start learning how to evaluate and underwrite deals, you should also be asking for things like the rent roll and the prior financial that the syndicator used, because that should all be information they should be allowing you to see, and then you can do your own evaluation, your own underwriting, and see if you're coming to the same conclusions that the syndicator has, in terms of once you look into the rent roll and you decide, hey, this is how they're paying today, is the rent growth that they're projecting too high? Or on the current financials, they have X, Y, and Z for expenses. Now they're saying they don't need that expense. And then you can start asking those educated questions based on the current situation and the pro forma that the syndicator is presenting to you.
And Marcelo's bringing up a really valid point. And this typically happens when you become more experienced. And he states a solid point about, underwriting the deal yourself. I do that a lot, but I'm experienced. First time investor, I don't think you're going to be able to, you're not going to know how to underwrite, but he brings up a really good point. Once you know how to underwrite, you then start to ask different questions because you know the model. And that's really important, but he's correct in talking about the other elements that you should look at, such as the rent roll. And the key points about the rent roll is looking at the bottom page to see what's the occupancy, but also know when you're looking at the rent roll, sometimes that owner is filling those places up just to fill them up. What you have to be able to look at is how many new, I always do this when I look at the rent roll, how many new apartments were leased in the last 3 months, 3 to 6 months? Because I want to know, is he just throwing people in to build up his occupancy numbers so that he can sell the apartment? Because that's going to tell me that first 3 to 6 months, they're going to have to kick a lot of people out because they can't pay rent. But that comes with experience.
Martin, I think you had a question or a comment you wanted to make there.
Yeah, I wanted to ask a little bit on the PPM. So the PPM is for guys who are new, is the private placement memorandum, which is a document redacted by the attorneys with every little clause on how the deal is going to be structured. Now, I was going to ask, because you have so much experience with PPMs are not required; they're just suggested on 506B syndications. They're required for 506C, but they're just suggested for 506B. In the group we usually hang out with and invest, it's a common practice. You've invested outside the group several times. Have you seen or have you invested in any deals where you didn't have a PPM and basically you had to trust the sponsors on what they offered?
I've been offered a number of times to invest in deals without that, and I just won't. I want to see some documentation because that's a little bit more risky. Now, if I know the area and I'm well versed in that area, I can look and then say whether I will do it or not. So I have not done any deals that do not provide that level of scrutiny and that level of detail. And that was even prior to me being in the ecosystem that we are all in. I looked at making sure we had the PPMs as well. So, but anytime you don't have a PPM, you need to just say to yourself, that's just going to be higher risk. It doesn't mean it's a bad deal. It doesn't mean it's a good deal. You just have to go through your risk assessment to understand, is it a good deal for you? That's the key.
Yeah, absolutely. Clayton, I think you had a question.
Yeah, so you've been in a number of deals, a lot of deals that probably all don't have the same, sponsorship team for those deals. So everybody's updates are a little bit different. Everybody kind of has a different approach for how they send information out, and certainly we all have different ways we like to receive it. So if you look back over the years, what are some of the favorite aspects of updates you've gotten from deal sponsors? What are some things that you're like, man, this is not any value at all, and I wish they wouldn't do this?
Yep.
What are some
Good
takeaways?
question. Not as good. For me, I like updates that give an executive summary to tell me the difference between the last time you sent out information. And it needs to be short and tight. I don't need a long explanation of everything. What I want to see: occupancy, NOI, occupancy, revenue, expenses, and NOI. Those are the things that I'm looking at, because that's going to tell me how things are going at a high level. Those are going to be my 4 KPIs, or key performance indicators, that I look for in this space right away. Then when I want to look into the detail, you got to make sure you have all the data, as Marcelo mentioned earlier, rent roll, the T12, all of those, the profit loss, all of that is something that you want to see. But I want the data to the executive summary to show in that email paragraph that we're going to look at. I also like graphs that kind of highlight what you said you were going to deliver and what you're actually delivering, because then that tells me how well you did in your pro forma, in your planning. And it doesn't have to be that you're going to achieve your pro forma, because that's then going to tell me about your risk. I mean, your ability to estimate what's going to happen as a syndicator. Now, I know there are lots of other extenuating circumstances, but that's going to give me a good feel for your ability to estimate. So I look for those things. Now, there are some things that I've received that I had one syndicator send an update that had 2 sentences on it. It had occupancy, it had net income, and then the NOI. And I was like, anything else going on? You got any before and afters, or what else is going on? Or and then I've had people that sent me paragraphs that I was like, whew, way too much detail. So I've seen a little bit of everything. The ones that do it, I think one of the people that do it really well is a gentleman, Shane Thomas. He does it really well. I like, because it's very professional. It's consultant. Like there's an exec summary. The key data is right there. And then when you want additional detail, you can click and go to it. So I hope that helps, Clayton.
Thanks.
Great. We're getting close to 8 o'clock here, and I just want to do one final roll call. If anybody has, this has been a great discussion. Anybody has any questions? Anything you'd like to hear more about in terms of selecting your passive investment and how to go for doing passive investment in multifamily?
Cody has a question. I have one question. How are you preparing yourself as a passive investor in case of a downturn?
I'm going to keep investing. I know there's going to be opportunities for syndicators, for people that are over. I'm waiting for a downturn, because that's going to be the time to move quick. Because people are scared, and people will sell quick, and prices will get depressed, and you'll be able to get into a good deal. I mean, I did it the last time, and I invested through the downturn, but I will keep investing. I will be a bit more conservative in my analysis, but I will continue to invest. And the thing that I think about as a downturn comes, I say to people all the time, they will still need to go to apartments. The people who are living in homes that are going to potentially lose their home in a downturn, where are they going? They're going to apartment complex. The people that are living in class A type of apartments, they probably gonna move to B's or C's, and then the B's and C's are gonna move to C's and D's. So I'm gonna keep investing because I think this space is a great vehicle. The syndicators will just have to hold longer. That's what you have to prepare yourself for, a downturn as a passive investor. You're gonna have to hold the investment a little longer than you typically would, because you gotta wait for that space for it to turn. But as long as it's cash flowing, I'm happy. When you stop giving me cash, then I start asking questions. And that's when I'm like, hey, what's happening? So I hope that answers.
Yeah, absolutely.
Yeah.
Yeah, Luis, we're gonna have to bring you back for another hour later on. But since we're getting close to the end, do you have in your mind any questions you would have liked us to ask you that would enlighten investors?
No, I think it's to what the audience needs. And so my hope is that I was able to give the audience some additional data that they can actually use in their analysis as they get ready to move forward in their investment perspective. The one question that I would probably ask myself that we didn't talk about at all on this call is, what strategy did I use? What was my strategy, right? Because my strategy was to get into investing. But once I got into it and I had a number of places in Houston, my next element of growth was, how do I diversify into different markets? Because I'm in 5 or 6 different markets, right? And now that I'm, in those 5 different markets, how am I maturing my strategy as I continue to invest and stuff like that? So that's probably a good question to kind of dig into. How do you move forward? But the strategy for a beginner is pick a place where you want to invest. Make sure you learn about that market, that area, or the 2 areas in your market that you really want to invest in. And then I'm going to just say the magic word, take actions. But if you don't take action, you're going to sit there and talk about all the stuff that you want to do for a long time. Mm-hmm. And I know a lot of people that do that. So, but just be smart about investing your money. So I'll stop there.
Perfect. Yeah, that's a great advice, Luis. With that, I just want to share to everybody, especially the folks that are new to our online meetup. We always meet the first and the third Wednesday of every month. So the first Wednesday, we focus on how to be a syndicator, how to get your first syndication. So that's going to be February 5th. And then again, we meet on the third Wednesday at always at 7 p.m. Central Time, which is going to be February 19th. And our focus there is how to be a better passive investor, how to perhaps get into your first passive investment.
Thank you for watching this week's episode of the Multifamily 0 to 1. Join us live the first and third Wednesday of every month.